The money management may not guarantee that you will make big profits in trading, but what is more important is that it can save money on your account. You have to know that with good money management and poor technical or fundamental analysis, there is still a chance to be profitable. But even with the most sophisticated technical analysis, but poor money management, losses are guaranteed. Money management is the most underrated part of Forex trading, especially among beginners, and which is why such a large percentage of Forex traders lose money. New traders ask themselves, as soon as they start trading, how much money can I make on this trade? Instead, it would be a lot smarter to ask yourself how much money I'm willing to lose on this trade. The answer to this question can only give you money management, or also called the risk management. And what the money management actually is. Money management is a set of rules that every trader should follow before and after opening a trading position. This is extremely important because with the help of these rules, we can exclude emotions, and emotions are what often causes us to make irreparable mistakes while trading. Money management should be adapted to the different types of trading and strategies, but basically it gives us answers to the following important questions. What is the risk per trade? How to calculate your risk? Where to put your stop loss and take profit? How to manage open trades? What is the risk-reward ratio? And when to exit your trades or close pending orders. In the following lessons, I will try to answer these questions, of course from my perspective and my experience gained in trading on the Forex market. The money management is also called risk management, so in this lesson I will try to advise you how much you should risk per each trade. First to say, there is no one answer to this question, such as 1%, 2%, 3% and so on. As you know, on Forex there are different groups of traders, so for example scalpers who have a lot of trades per day, it is normal to enter slightly less in each trade, for example 0.5 or 1% of the total account. In contrast, investors only have a few trades a month or even less, so they sometimes invest as 10% or more of the total account in one trade. I deal with swing strategies, which means that I keep my positions mostly open for a few days and have 2 or 3 trades a week at maximum. After almost 10 years of experience on Forex, I realized that it is best for me to invest 2% of my total account in each trade. Basically, this means that if I have 10,000 euro in my account, I am ready to lose 200 euro per one trade. The risk of 2% is enough to make a nice profit over a long period of time, but also in my opinion 2% is not that much to take a large part of your account during a bad period. This is very important from a psychological point of view. Believe me, even a professional trader may lose 10 trades in a row. If you invest 10% in each trade, such losing streak would take you all the money from the account. A risk of 5% per trade would take you 50% of the account. This can cause to have fear when you play each next trade, which ultimately causes you to make the wrong decisions. Many professional traders advise that the risk per trade should not exceed 1% of the total account. This is an amount that I have used for many years, but in the end I realized that for my trading method I could freely raise my risk to 2% per each trade. Okay, what would be some advice for you? Since I believe there are no students among you who want to be investors, but traders, I will make simple divisions. Ask yourself if you want to trading fast with lots of positions played during the day or want more peaceful trading method, which I personally prefer. We talked about these divisions in earlier lessons. Try to remember, we talked about scalper, intraday and swing traders. If you forgot, go back to these lessons and remind yourself of the difference between these types of traders and decide which one you belong to or which group you would prefer to belong to. If you belong to the scalper or intraday traders, then my recommendation is to risk 0.5% or 1% per each trade. If you are on the swing traders side, feel free to risk 2% per each trade. And now that many beginners do not know how to calculate what amount to set in order to risk, for example, 2%, in the next lesson I will show you a simple formula how to do it. We said what money management is, what answers money management should provide to us, and how much risk we should take on each trade. Now I'm going to show you how you can easily calculate the number of lots, that is the position size you need to invest in a trade to set the risk as much as you want. Many traders have a problem with this issue, so I think it's very important to show you how you can do it an easy way. Some platforms have the option to simply enter the amount of money you want to risk, or have the option to simply enter the percentage you want to risk. So, for example, if you want to risk 2% on a trade, you simply enter number 2 and that's it. Unfortunately, even the MT4 is one of the best and most used platforms in the world, this option is missing. So when you are going to enter the amount you want to invest in a trade, you have the option to choose between 0.01 and, as you can see, several lots. This often confuses traders, especially beginners. Then you can make mistakes and end up with big loss. Now, in one simple example, I will show you how to calculate position size and always take the risk you want. Since most of you have a dollar account, I will first show the formula for calculating the position size for all you with dollar account. You can see a euro-dollar currency pair chart in front of you. Of course, this formula can be used for all other currency pairs. Pay attention to this form, write it down, I'm sure you will need it. Okay, so the first item is balance, your balance times risk per trade, divided by stop loss times the value of pips. So here we have a few items that are unknown for us, and now we are going to determine it. How much is our balance? $10,000. Okay, we have that info. Trade risk, how much is it? How much we are going to risk? In the last lesson, I said that I risk 2%, so we will use that amount in this example. 2% in decimal is 0.02. The next item is stop loss. We don't have that information. In order to calculate the position size, we have to determine the stop loss. I will roughly choose some level. This is euro-dollar currency pair, the price falls a lot. Let's say there will be a reversal and the price will start going up. For example, we will open a buy position and we'll set stop loss here. Let's see how many pips is that. That's 175 pips. So the stop loss is 175 pips. And the last item is the pips value for one lot. How will determine the value of 1 pips on euro-dollar or any other currency pair? Simply type in Google pip value calculator. There are many. I have selected the first one that was offered. You can find the pip values for any currency pair here. Enter the amount of pips in the first field. Just enter 1 because we want to find out the value of 1 pip. Choose the currency pair you are trading with. As we trade with euro-dollar currency pair, we'll leave it. Trade size, its number of lots. We ask for the value of 1 pip for 1 lot. So here always leave 1. And the last field is deposit currency. That is our account currency. The currency of our account is $1, so I leave it as it is. And here we see that amount, the value of 1 pip on euro-dollar currency pair for 1 lot size is $10. The number we need is number 10. Now let's calculate. 10,000 times 0.02 equals 200, divided by 175 times 10 equal 7050. 200 divided by 1750 equals 0.11428. Since we do not have the option for entering so many decimals, but only 2, we will enter the closest amount. This means that our risk will not be exactly $200, but somewhere around that amount. It's not that important. It is important that it be close to that amount, 0.11428. So let it be 0.11. Okay, let's try. In the volume field, we will enter the amount 0.11. Stop loss is this amount we have marked. It is 1.04826. And I will click on the buy by market field. Okay, I'm going to delete this red line. Okay, let's check our risk. All I need to do is move the mouse cursor over this red dashed line. Look, the risk is 199.10. As you have seen, you can use this formula on any other currency pair. If you trade with another pair, just enter that pair into the calculator. For example, if you trade with US dollar Swiss franc currency pair, you need to select it here. You see the amount is slightly different, 10,1698. So in the formula you should enter this amount instead of 10 and you would get the amount of lots that should be entered in this field here. Now it is your turn. In your demo account, choose several currency pairs and try to calculate position size. However, since some traders do not have a dollar account deposited, in the next lesson I will show you one more formula. I will only add one item and you will see how to calculate position size if your trading account is not a dollar account. Since I can open an account in dollars, euro or British pounds with my broker, I have opened one demo account in British pounds. In any case, the principle is the same and can be used for any other currency. We'll use the same formula as the last time, but we'll add one more item to the upper part of the formula. This is the currency rate of your account against the dollar. I just typed GBP to USD in Google and got that rate. Here we see 1.16. Let's try it out with a practical example. We'll open a trade, for example, on the currency pair Euro-Japanese Yen. This time we'll open the sell position and I will place a stop loss above this point here. The first we will determine the stop loss amount from the current price level to the stop loss. It is exactly 105 pips. Okay, let's try it. The amount of our deposit is £10,000 times 2% again. That's 0.02 times the GBP USD rate. It's 1.16. For example, if your account is in Indian rupees, enter rupee to USD. If you have an account in Russian ruble, enter ruble to USD, Australian dollar to USD, Canadian dollar to USD, and so on. So we add to the upper part 1.16 and divide that by the amount of pips is how much? 105 times the value of 1 pips for the Euro Japanese Yen. The value of 1 pip is 9.00017, which means 9. I'll enter that amount in the formula and let's see how much it is. 10,000 times 0.02 times 1.16 equals 232. 105 times 9 equals 945. 232 divided by 945 equals 0.2455. So we need to invest about 0.25 lots in the trade in order to risk 2% or £200. That's what we got in this formula, but let's see if this is true. I will click on the new order field and enter 0.25 in the volume field. Stop loss is the amount we marked. It is 190.44 and I will click on the sell by market field. Okay, I'll delete this red line, put the mouse cursor on the dashed line and we can see the risk is 198, which is about 2% or £200. That would be it. Now you should try. Use any pair, determine the risk and stop loss and try to calculate the position size. Which is where to set up a stop loss order. Most of you probably know what a stop loss is, but let's repeat. A stop loss is an option that allows traders to limit their losses. These are orders that traders generally place even before they open the trade and they are active even when the platform is off. So if you're not close to the platform, you don't have to worry. You certainly cannot lose more than you set with your stop loss order. This question is very important because if you set too little stop loss, you will have a lot of losing trades. If you put too large stop loss, you will have a bad risk-reward ratio. I will talk about it in another lesson. Since every trader has their own trading strategy and therefore a strategy of setting a stop loss and take profit orders, I will show to you how I do it in my way. As the essence of my trading comes down to finding support and resistance levels, I'll use such one example to explain how I set up a stop loss order. I have dedicated the entire part of the course to support and resistance levels, so if you are still unsure how to determine these zones, go back a few lessons and look at them again. If any of you are still wondering whether to use stop loss in trading, I'll simply tell you yes and always. You see the USD Swiss franc currency pair in front of you. As you can see, I marked 3 zones. Why did I mark these 3 zones? I just saw that the price bounced off these zones many times and then made reversals. It's here, then here, here, and here. Also down here, here once, twice, 3 times. Here in the middle we see that the price has bounced several times from that zone. We see it here as well. I would certainly not enter the position at this level, but if the price jumps or falls, those 2 zones would be good for trading. This means that if the price jumps to this upper zone, we have a sell signal. For example, if we decide to place a sell position at the beginning of that zone, where should we place a stop loss? Setting a small stop loss means that we have a chance to make more money on this trade, but it also means that we will have more chances of losing money on this trade. Why? Because wicks or shadows often happens on the charts. You can see it here and then here. If you place a small stop loss, for example, at the end of this zone, there is a good chance if the price enters this zone that a short jump will occur and break through this zone as happened before. In such a situation, we would lose money because the stop loss level would be reached. On the other hand, if we set too high stop loss to protect our trade from the risk, we would have a very bad risk-reward ratio. This would mean that we need to have much more winning trades than losing ones in order to be profitable at the end. We will talk about this in this part of the course. What I do is I always set a stop loss just above the zone I marked. If you ask me how much it is, it depends on time frames. It can be 5 pips, 10 or 15 pips. Basically mark the zone and lift the stop loss at a minimum by half of that zone and maximum by the thickness of that zone. About this is a half the zone. This was an example of the support and resistance levels I determined based on the major high and lows on the chart. You can also mark support and resistance zone in other ways. Here we can see a similar situation. The previous 3 picks are in the same zone, so here we also have a good situation for sell position. So where do we need to put a stop loss? A few pips above this top here. So it's about here somewhere, if the entry level would be at the beginning of the zone. You can also find zones of support and resistance with the help of channels. I talked about it in the course. There is no need to repeat myself now. I also talked about trend lines, a zone of support and resistance. You can also use Fibonacci. I really use this tool a lot in trading. As for Fibonacci, we have a good situation here. If the price drops to 61.8, we would get pattern AB equals CD. This means that if the price drops to 61.8, we would have a good signal to open a buy position. Many traders would put a stop loss just below that level because of the higher profit, but I think it's not wise. The safest rule in trading with Fibonacci is if at one level you're entering a trade, then set up a stop loss below the next level. If you do not want to set such a high stop loss, then put it a minimum between 2 fib levels. There is a very low chance that price hits the level of 61.8 and then start rising immediately. Just as level 38.2 was broken, so it's possible that level 61.8 will be broken also, so you need to put the stop loss between these 2 levels, but it would be even safer to put it below the next Fibonacci level. Like I said, support and resistance levels can be determined in different ways. This is a trend line. But don't just look at it as a line, but try to think of it as a zone. A stop loss should be set above that zone. Also similar to the channel pattern, which often happens on chart, consider these lines as zones. At the beginning of the zone, enter the position and a stop loss place below the zone. Okay, that would be it. Try to create a specific zone around the level at which you want to open a position and always place a stop loss below that zone. So it must be neither too small nor too big. But how do you know the stop loss is too big? Simply, if your take profit is less or equal to stop loss, then something is not quite right. I try to make my take profit at least double the stop loss. Take profit is not as important as stop loss is because it is much more important to limit your loss than your profit. But many traders use this option and many beginners have a dilemma of where to place this order. I mainly use this option in trading, and my personal rule is that take profit is minimum 2 times bigger than the stop loss. However, for take profits I never use a certain number of pips, but let the price fall or rise to the level I think it can go. I will use the same example. In the last lesson we said that at the beginning of this zone we would open a sell position and place a stop loss above that zone. Now the question is where to place a take profit. How much the price can fall from this level. Honestly, I see no reason to put take profit anywhere before this support resistance zone. We can see that the price has bounced several times from that zone. We can also see here that this zone of support resistance is confirmed, which means that we should pay attention to this zone. If the price starts to fall, I see no barrier for the price other than this zone, which means that I would place take profit somewhere at the beginning of this zone. As we can see, this take profit is about twice the stop loss, which corresponds to my trading rules. We can use the same strategy if the price goes down. I think this is a strong support zone. If the price drops to this level, we will have a buy signal. If that happened, I would open a position at the beginning of this zone, while the stop loss I would place below this bottom here. I would not limit take profit to a certain number of pips, nor set it to be 2 times higher than the stop loss, but I would allow the price to rise to this zone of support resistance. Why? Well, because I don't see any other obstacle that would stop the growth of price, and I think it can reach this zone. In this situation, we see that the profit is even higher, perhaps 3 times higher than stop loss. So, I never use any strict rule regarding take profits. Sometimes it is larger 2 times, sometimes 3 times, sometimes even 5 times. It all depends on the situation. Why would I limit take profits to, for example, this level here or this one here, when I do not see any obstacle for the price? If the price starts to rise, I think it can reach this level here, and why not take this opportunity? Why to reduce my profit? So this is the profit I would expect on this trade. To summarize, as you have seen, I do not use some strict rules for determining stop loss and take profits, but instead I mark the important support and resistance zones on the chart and adjust stop loss and take profit based on this zone. In terms of take profit, I let the price move from one zone to another, but I still have one rule, and that is that my take profit will be at least twice higher than stop loss. In the next lesson, I will tell you why I want the risk-reward ratio to be a minimum of 1 to 2. We'll talk about this in the following lessons. As the name implies, it represents the ratio of risk and profit, that is, how much profit we expect per 1 unit of risk. This ratio is adjusted on the chart with stop loss and take profit orders. Setting a stop loss and take profit of 10 pips means that our risk-reward ratio is 1 per 1. If we risk 10 pips and set a take profit of 20 pips, that means that our risk-reward ratio is 1 per 2. The same stop loss with 30 pips of take profit is risk-reward ratio of 1 per 3, and so on. So the question is, what risk-reward ratio traders should use? First of all, it depends on the strategy they are using in trading. Generally, scalpers, that is traders who have a lot of trades, use a lower risk-reward ratio such as 1/1, while swing traders like me generally use a higher risk-reward ratio like 1/2 and often more. The risk-reward ratio has a direct impact on win rate, that means the percentage of winning trades. Traders who use a 1/1 risk-reward ratio must have a high win rate in order to be profitable. A 1/1 risk-reward ratio means that 50% of the winning trades will only provide you break-even, while anything below that indicates a negative results. Risk-reward ratio of 1/2 means that it is enough that out of 3 trades, you can win 1 trade and lose 2 trades, and you will have a break-even. This means that it is enough to guess only 33% of trades and have a mistake in 67 of cases, and again, you will not lose anything. Risk-reward ratio of 1/3 means that it's enough to hit 1 out of 4 trades, and you will have break-even. This means that you can only have 25% of winning trades and 75 of trades you can lose, and your account will still remain the same. Although it seems that it is better to use a higher risk-reward ratio, essentially it pulls low win rate with itself, and finally you come to the same. Low risk-reward ratio means high win rate, high risk-reward ratio means low win rate. If you're wondering now what is the point is to increase your risk-reward ratio as much as possible without much impact on win rate. This is done by adjusting trade entry levels, stop loss levels, and take profit levels. I never use the same risk-reward ratio. I try to adjust it to the situation on the chart, but still I want to keep it at a minimum of 1/2 ratio. What is all about? Every trader should strive to have as high risk-reward ratio as possible while maintaining as good a win rate level as possible. The easiest way to do this, and I'll show you now, is to adjust the trade entry level. You see the Euro-Japanese yen currency pair in front of you. I marked 2 zones. The upper zone is the resistance zone, while the lower zone is the support zone. In the first zone, I found a few picks. There are 5. 1, 2, 3, 4, 5. The bottom zone is formed by 2 trend lines. I wanted the zone to contain the maximum number of points. These are 1, 2, 3, 4, 5, 6, 7, and 8. 8 previous bottoms in one zone. We see that the price is moving between these 2 zones, and there is a chance that it will continue for at least some short time. The price is currently between these 2 zones. We cannot know if the price will now rise or fall. But if for some reason we decide to enter the sell position in this situation, where should we place stop loss and take profit? Since this is an important zone for us, stop loss must be above that zone, because only this zone protects my stop loss from growth of price. Where will we place the take profit? If the price starts to fall, there is no reason for it not to reach this zone again, so I will put take profit slightly ahead of that zone. We can see that the ratio between risk and profit is almost the same, which means that the risk-reward ratio on this trade is 1/1. So this is a situation where we expect a $1 reward for $1 invested. Of course, if we guess the direction of the price movement. Honestly, I would not accept this game because I don't think it's worth the risk. The question is how we can fix this situation. We have determined the stop loss. It has a good place. Take profit is also in a good position. What I would change is the level of entry into the position. If the price continues to rise, I see no reason why it would not reach the resistance zone again, because it did it so many times before. I do not know if the price will reach this level or it will start falling immediately, but what I know, in this situation, for $1 invested, to see how much pips is there, around 35, and take profit is around 180, that's about 1/5. In this case, I expect $5 of profit on $1 invested. So in this first case, in order to win this trade, we have to wait for the price to hit take profit. If we move the trade entry level up, we again want the price to fall to the same level, so I didn't change the level of expected profit. Also, I didn't change the stop loss. If we decide to risk 1% on this trade, whether we open the trade now or move the trade entry up, the risk will be 1%. Because it's our decision, but in the first case, our take profit is 1%, the same as the risk, and I don't want to play that game. It's just not attractive to me. In the second situation, if the price jumps and hits the level I have marked, I will accept that risk because I will expect a much higher reward for the same risk. Just waiting for the ideal level to enter a position is the simplest way to increase your risk-reward ratio. As you have seen, I didn't change stop loss. It remained at the same level. I didn't change the risk. We decided to be 1%. I didn't change the take profit. And the only thing I changed was the trade entry level. I don't know if the price will reach that level I have marked, but I know that if that happens, I will have opportunity to make a good profit. This is a game I'm ready to play because this is a reward worth the risk. I hope you understood everything. I use this system in my trading strategy with Fibonacci clusters. I described this strategy in detail in another course I dedicated to Fibonacci. There, during live trading, I showed how I use this money management system, and I also showed the results of trading. This strategy is based on a very strong setup and can often result in a major reversals, just from these zones which we found with the help of the Fibonacci cluster strategy. For this reason, I often set a very high risk-reward ratio, which means I expect a much higher profit than a risk. However, when you set a much higher take profit compared to a stop loss, or when you have a high risk-reward ratio, it generally leads to a low win rate. With this money management system, I'm trying to maintain a balance between a good win rate and a high risk-reward ratio. Okay, let me show you what it looks like on a chart. I marked one zone. This is a support zone as it's below the current price. This means that if the price falls in this zone, we will have a buy signal. I risk 2% per trade, but now I will open 2 positions instead of 1. I will risk 1% per each position. Trade entry level should be at the beginning of this zone and stop loss should be below this bottom. Both positions have the same trade entry levels and the same stop loss levels. The difference is only in the take profit. The first take profit I determine in a simple way. It is always twice higher than the stop loss. If my stop loss is about, 40 pips, take profit should be about 80 pips. If you try to trade with Fibonacci clusters, you will see that the price often reacts from those levels and often happens to reach the level of the first take profit. This is important because it provides me to have a good win ratio. Occasionally there is also a major trend reversals after these formations, which is why I place other take profits at a much higher levels. Where could that be? It could be some other zone from which the price could bounce off. I see a few picks here, which means that I would set the second take profit minimum at this level here. The next zone is around these bottoms. Or I could even place take profits a little below these tops. We see that the price many times before reach this level, so there is a chance that if the price starts to rise, reach that level again. Let's see what can happen now. If the price goes down and hit our trade entry level, the both positions will be automatically activated. So we need to set up 2 pending orders first. On each position, we risk 1% of total account. The first take profit is 2 times higher, so it's 2%, while the second take profit is higher and it can be 3%, 4%, 5%, and so on. If the price drops and activates these positions, what can happen? If the price continues to fall and hit the stop loss, both positions will be closed automatically and we will end this trade with a 2% of loss. if the price goes up and hits the first take profit, the first position will be automatically closed and we will earn 2% of profit. So this trade will be closed and it no longer exists for us. In this situation now, we can lose 1% on the second trade or earn big profit. When the price hits first take profit and the position is closed, I click on second stop loss and move it to the break even in order to protect the second trade from loss. Now I cannot lose anything on this trade, but can make a good profit. If the price continues to rise, then I can move the stop loss even more above to secure some level of profit. As you have seen, the strategy is very simple. Instead of opening one, I open two positions, risking 1% on each. The first take profit serves to maintain a good win rate, and the second take profit serves to make big profits. That would be it. I hope you understood everything. If you don't have your own money management system, try to use this one. I have to say that this system is just for swing strategies. I'm dealing with swing strategies. One of it is mentioned, and this is Fibonacci clusters trading strategy. If you're interested in trading with Fibonacci, at the end of this course, you have discounted coupons that can be used by all students who have enrolled in this course. So if you find it interesting, you can add this strategy to your daily trading. Thank you very much for your attention. That would be it for money management.